Hi, I'm Daram Abdullah, ETF strategist at Invesco Canada. ETFs, or exchange-traded funds, have gained significant popularity with investors due to their ease of access and potential for diversification. However, it's important to understand that ETFs, like any investment, come with their own set of risks. In this video, I'll discuss some of the key risks associated with ETFs, including market risk, concentration risk, trading risk, and tracking error, along with relevant examples. Let's start with market risk, which is an inherent risk that affects all types of investments, including ETFs. Market risk refers to the possibility of losing money due to fluctuations in the overall market conditions. Since ETFs track a specific index or sector, they're exposed to market volatility. For example, if you're invested in an ETF that tracks the S&P 500 index, a commonly held benchmark representing the US equity market, and the S&P 500 goes down 10%, your ETF, which tracks it, would follow. Concentration risk is also a concern, particularly for ETFs focusing on a specific sector, industry, or geographic region. These specialized ETFs tend to have a narrower range of holdings than broader market ETFs. While concentrated ETFs may offer the potential for higher returns if the specific sector or region performs well, they also carry a higher degree of risk if the sector or region faces adverse conditions, such as regulatory changes or economic downturns. The concentrated ETFs may experience significant losses. For instance, an ETF that exclusively tracks the energy sector would be vulnerable to the impact of declining oil prices or changes in government policies affecting the industry. Another risk to consider is trading risk. ETFs are traded on stock exchanges, so they are affected by market liquidity and trading volume. If an ETF has low trading volume, it can lead to wider bid-ask spreads, which can increase transaction costs for investors. Furthermore, during periods of heightened market volatility, the prices of ETFs can deviate from their underlying net asset value. This phenomenon, known as premium/discount risk, can occur when the supply and demand dynamics in the market cause the ETF's market price to deviate from the value of its underlying assets. Investors may face challenges buying or selling ETFs at fair prices, which can result in trading losses. Finally, tracking error is a risk that arises from the ETF's ability to replicate the performance of underlying index. While ETFs aim to track the index and are designed to replicate it closely, there can be slight discrepancies between the ETF's returns and the index's returns. This deviation is known as tracking error and can occur due to factors such as fees, expenses, and sampling techniques employed by the ETF. A higher tracking error can lead to underperformance compared to the index, reducing the ETF's expected returns. It's important for investors to assess the historical tracking error of any ETF before investing so that they can understand how closely it has tracked its underlying index in the past. In conclusion, while ETFs offer benefits such as diversification and accessibility, it's crucial for investors to be aware of the associated risks. Market risks, concentration risks, trading risk, and tracking error are some of the key risks to consider. Investors should thoroughly research and evaluate an ETF's characteristics, holdings, historical performance, and risk factors before making investment decisions.